over 1,200 radio stations, 245 million Americans tuning in every single month, stations in 247 of the nation's 250 biggest markets, stock returns of 1,300% in 5 years, revenue of $6.7 billion a year. This was iHeartMedia, the most dominant radio company America has ever seen. Today, $20 billion in debt. Chapter 11, Bankruptcy. Over 7,000 jobs wiped out, not a single annual profit since 2007. So how did private equity take one of the most profitable media empires in American history and turn it into a financial graveyard? Bain Capital and Thomas H. Lee Partners put up roughly $2 billion of their own money, then loaded $10 billion in new debt onto the company to pay themselves back. The company funded its own destruction. Today we're exposing 5 fatal flaws that buried America's radio empire. Let's break down how private equity turned profit into poison. Fatal flaw. Number 1. The leveraged buyout that made the company pay for its own funeral. Most people think iHeartMedia went bankrupt because radio is dying. That's the convenient narrative, and it's wrong. In 2008, Bain Capital and Thomas H. Lee Partners bought Clear Channel Communications for $17.9 billion, beating out Blackstone, KKR, and Providence Equity Partners. They committed roughly $2 billion of their own equity. The banks, Citigroup, Deutsche Bank, Morgan Stanley, Credit Suisse, Royal Bank of Scotland, and Wachovia financed the rest. And here's the kicker. Clear Channel was already carrying $8 billion in debt before the deal even closed. The leveraged buyout piled on another $10 billion. When everything was done, the company owed $18.4 billion. The deal closed in July of 2008, weeks before the financial crisis started tearing credit markets apart. When those banks tried to back out, Bain and Thomas H. Lee sued all 6 of them, forcing the deal through. The result? A profitable media empire became a debt servicing machine overnight. Revenue dropped from $6.7 billion in 2008 to $5.5 billion in 2009, and it never recovered above $6.3 billion. Every dollar went to interest payments instead of innovation, and the company did not post a single annual net profit for over a decade. But if borrowing $20 billion to buy a radio company sounds reckless, wait until you see what the interest payments alone did to the business. Fatal flaw. Number 2, $1.4 billion a year in interest. The debt that ate the company alive. You've probably heard iHeartMedia's leadership talk about the company's strong operating business. That part was actually true. The operating business was growing revenue for 18 consecutive quarters before bankruptcy. But here's the financial reality, none of that mattered. By 2017, annual interest payments had ballooned to $1.4 billion, consuming roughly 22% of total revenue before a single employee was paid or a single song was licensed. The debt had innumerable layers, structured across multiple subsidiaries with different maturities and creditor classes, making refinancing nearly impossible. That same year, management issued a formal going concern warning, admitting substantial doubt about surviving the next 12 months. The stock collapsed to 52 cents a share. Compare that to the $36 buyout price. Bottom line, $0 were available for digital transformation, while Spotify, Pandora, SiriusXM, and every podcast platform on earth were capturing the next generation of listeners. The company sold radio towers for $400 million, sold all its television stations, and shed over 500 smaller radio stations. And it still was not enough. And if $1.4 billion a year in interest payments wasn't devastating enough, what the PE firms did to local radio and the thousands of people who made it work was even worse. Fatal flaw. Number 3, gutting local radio to service Wall Street debt. iHeartMedia loved to say our people are our company's most important asset. Then they invented a new word for firing them, employee dislocation. The debt forced radical cost cutting across every market. Local program directors were eliminated. DJs were replaced with automation. Stations in dozens of markets lost all local staff. When the FCC eliminated the main studio rule in 2017, meaning stations no longer needed a manned studio near their broadcast license, iHeartMedia used that to wipe out local positions entirely. The numbers tell the story. Pre-bankruptcy workforce, approximately 18,000 employees. By 2024, roughly 10,800. Over 7,000 jobs gone. In January of 2020, mass layoffs hit so hard that one former on-air host called it one of the worst days in on-air radio history. The cuts were concentrated in small and medium markets where staffs had already been stripped bare. The Future of Music Coalition found that this ownership consolidation led to loss of jobs, decreased format variety, and dice economies of scale that hurt the entire broadcasting business. As one former station owner described his community after iHeartMedia took over, they do zero community work. They don't give our community a voice. And let's be real, the cost cutting meant to save the company accelerated the audience decline. Listeners tuned out and turned to digital alternatives, community stations, anywhere that still had a human behind the microphone. If you're finding this financial breakdown valuable, hit that like button to help other viewers understand these corporate truths. But if gutting local radio to pay Wall Street was bad, the actual bankruptcy filing revealed something even more infuriating about how private equity protects itself. Fatal flaw. Number 4, the PE firms walked away whole. Everyone else paid the price. You'd assume that when a $24 billion deal collapses into bankruptcy, the buyers lose everything. That's how it's supposed to work. You take the risk, you take the loss. But Bain Capital and Thomas H. Lee Partners didn't play by those rules. Despite the company filing for Chapter 11 with over $20 billion in debt, the two PE firms approximately broke even on the entire investment. How? The dirty secret is 2 tactics. First, they collected millions in management fees every single year throughout a decade of ownership. Second, when iHeartMedia's bonds started trading at distressed levels, the PE firms bought their own company's debt at steep discounts, positioning themselves as creditors, not equity holders who'd get wiped out. Bain even transferred assets between iHeartMedia subsidiaries, prompting lenders to sue, claiming $1.241 billion in collateral had been moved out of their reach. After bankruptcy, Bain and Thomas H. Lee received about 1% of the new common stock, a token. But they had already recouped their investment. Meanwhile, over $10 billion in debt was restructured away, money owed to bondholders, pension funds, and institutional investors who absorbed the losses. And CEO Bob Pittman, he stayed on with a new 4-year contract extension. You won't believe what fatal flaw number 5 reveals about what happened next. Fatal flaw number 5. Post-bankruptcy, the debt machine never stopped. The official narrative was that bankruptcy would fix everything. CEO Bob Pittman called the restructuring a significant accomplishment and promised a vastly improved financial profile. The truth is, iHeartMedia emerged from Chapter 11 in May of 2019 with $5.75 billion in debt still on the books. By 2024, the company was back on the financial distress list with over $5.2 billion in long-term debt, and the layoffs never stopped. As recently as April of 2026, iHeartMedia announced a $100 million cost reduction push, cutting regional managers, on-air hosts, program directors, and production staff across the country. The company is now replacing human talent with artificial intelligence in its broadcast operations. Veteran employees describe the new model as making one person do 40 people's jobs. The company that once dominated 247 of 250 markets now struggles to maintain any meaningful local presence. The private equity debt hangover, even after restructuring, continues to dictate every decision nearly 2 decades after the original buyout. Subscribe to the channel now and turn on notifications so you don't miss out on more critical financial insights. Here's what you need to understand. iHeartMedia didn't die because radio died. The operating business was generating revenue, growing audiences, and turning operational profit. What killed it was a private equity playbook. Load a company with debt it cannot sustain, extract fees and restructuring profits, gut the workforce to service interest payments, and walk away when the structure collapses, leaving employees, creditors, and communities to absorb the damage. This is the same blueprint private equity has used from Toys R Us to Guitar Center to iHeartMedia. Understanding this playbook is the first step to protecting yourself as an investor, an employee, or a consumer. Hit like if you found this breakdown useful and subscribe to the channel now. I'll continue to guide you through the real facts of corporate finance, saving you from costly mistakes. Next time, we're breaking down another private equity disaster that destroyed a company you grew up with. You won't want to miss it. Stay informed, stay skeptical, and never take the corporate narrative at face value.